Hello everyone, how are you all doing out there? I'm Kate Hill, bringing you the best, unbiased and honest content on property, along with fantastic hints and tips, area profiles and all sorts. Stay tuned today for all your latest property news. Inflation has now dropped to its lowest level in nearly 18 months, which was a result that surprised many forecasters as well as the Reserve Bank itself, it seems. According to the Consumer Price Index for the June quarter, headline inflation fell to 6% in June from 7% in March, which was weaker than market expectations of 6.2% and lower than the RBA's official forecasts. Headline inflation has now fallen nearly 2 percentage points from 7.8% in the December quarter to 6% in the June quarter, or in just 6 months. The June quarter inflation reading was also 0.8%, which was the lowest level since September 21. If one was to annualize this quarterly result for the year ahead, that would see inflation at 3.6% annually, which is very close to the Reserve's target band of 2 to 3%. While it's clear that the rapid increase in interest rates has significantly slowed consumer spending, as it was intended to, there are some interesting analytics in the latest index. According to the Australian Bureau of Statistics, services annual inflation recorded its largest annual rise since 2001, driven by higher prices in a range of services categories, including rents, restaurants, meals, holiday travel, and insurance. However, goods annual inflation continued to ease from 7.6% in the March quarter to 5.8% in that June quarter, after 2 years of really strong price increases. Price rises for food, furniture, appliances and clothes slowed in the June quarter, while automotive fuel prices were 3.6% lower compared to 12 months ago. Also, according to the ABS, the rate of growth in new dwelling prices continued to slow. Having peaked in the September 22 quarter at 20.7%, annual inflation has fallen for the past 3 quarters to 7.8% in that June 23 quarter. The ABS said the recent moderation in price growth reflects lower new demand, improvements in the supply materials, and material costs easing. So what does all this mean? Prior to the release of the June quarter inflation figures, markets were predicting a 50-50 or so chance of another interest rate hike at the RBA's August meeting. Directly after the inflation results, though, that had fallen to just 14%, which was, of course, then the indicator for rates to be kept on hold in August, which is what happened. It certainly does appear that the peak of interest rates is near, or even right now, which will be a relief to borrowers. It must be said, though, that the forecasted mortgage cliff so far has not eventuated, and that's because the vast majority of borrowers are longer-term property owners who had the benefit of appreciating the record low interest rate environment for what it was, a glorious moment in time. It was never going to last. A lot of them were also very heavily cashed up, while some newer property buyers who may have overextended themselves financially may have experienced and will experience some issues. This was never going to be the case for many or most property owners, hence why we haven't seen any significant uptick in distressed sales. In fact, the total number of listings currently for sale in many markets around the country is so low that it is one of the reasons why property prices have been recording strong price growth over the past few months. So while it does seem like we might start to see some moderation in interest rates over the next 6 to 12 months, it's clear that even when rates were increasing at the fastest rate in a generation, it did not bother, or it didn't even bother buyers much at all. Plus, all the signs and the metrics point to continued strong market conditions, with buyer demand high, listings remaining very thin on the ground. I will keep you posted on all things property from around Australia, as always, as our year progresses. If you are enjoying all this fabulous content, then don't forget to subscribe and like, and I will see you again really soon. Bye.